This week, some of the loudest voices at the Federal Reserve said they might need to raise rates. Then the data walked in and settled the argument. Two inflation reports came in cooler than expected, and mortgage rates ended the week at their lowest point. When the microphone and the money disagree, watch the money. Here's what that means for you and your family. I'm Ron Sigel, Certified Liability Advisor, helping families build wealth through strategic debt management. This is your weekend update for the week of July 17, 2026. Let's start with the big picture. Early this week, a few Fed members said they think the Fed may need to raise rates, and the reason was inflation. One official even warned a hike could come soon if the numbers ran hot. A lot of that worry traces back to one place, and that's oil. The war with Iran flared up again, fuel prices jumped, and that pushed rates higher for a few days. The fear of inflation had traders betting a rate hike was almost certain by the end of the year. Then the mood changed, and fast. Two inflation reports came in much cooler than expected. On Tuesday, the Consumer Price Index showed prices barely moved, and the yearly core rate eased to 2.6%. That was the biggest surprise to the downside in more than a year. The next day, a second report on wholesale prices told the same story. In plain terms, inflation is cooling faster than people thought. Traders went from betting on an almost certain rate hike by December to pricing out most of the risk of any hike this year. That's good news if you've been waiting on rates. So where did that leave rates? At their best levels of the week. Rates started the week near their highest point in nearly a year, then eased lower each day. Here are this week's national averages. The 30-year conventional, 6.63%. The 30-year jumbo is 6.83%. The 30-year FHA, 6.25%, and the 30-year VA, 6.26%. These are national averages from Mortgage News Daily, not an offer to lend. As for the 10-year Treasury, which drives mortgage rates, the market is now closed for the week. The 10-year finished near 4.55%, down from 4.57% a week ago, and it's well off its highs from earlier in the week. That's a welcome move in the right direction. What about the road ahead? Right now, the 10-year is parked near 4.5%, which is close to just right level. Think of it as a boxed in with a floor around 4.2% and a ceiling around 4.8%. Which line breaks first depends a lot on the two wars in the headlines, Ukraine and Iran. If those conflicts cool down, rates could ease further. If they get worse, rates could climb. It's a picture worth watching. So what does this mean for housing? The market still feels the weight of higher rates. Signed contracts on existing homes fell 5.4% in June, one of the weakest Junes on record. Even as prices reached a new high, builders are feeling it too. About 37% of them cut prices in July. Nearly 2 out of 3 are offering incentives to sell homes. If you're shopping, that means there is room to negotiate, and asking about a builder incentive is smart. There's one twist worth knowing. There are not many new homes being built right now. Permits for new single-family homes sit near their lowest level in about a year. So while things feel slow today, there's not a flood of new houses on the way. If you're thinking about buying, that tight supply is worth keeping in mind. Now, let's get to the tools and articles we picked for you this week. You'll find these on the right side of the screen or below the video, depending on the device you're using. Number 1, bankruptcy stops hurting your score after 2 years. These 7 moves rebuild it fast. Number 2, from broke on paper to approved on cash flow. No new income required. Number 3, new student loan rules could change your payment, your limits, and your credit. We'll show you the math. Number 4, selling your home without an agent costs the average seller $65,000. In California, double it. There are more waiting for you as well. That second article points to something we want to highlight this week. Maybe your tax returns do not show the full picture of what you really earn. If you're self-employed and your CPA does a great job using every legal deduction to lower your taxable income, a regular loan can make you look like you earn less than you actually do. Our bank statement loan fixes that. We look at money you really deposit, not the smaller number left after write-offs. For a business owner with healthy cash flow, that can be the difference between a no and a yes. You can get the details at rsrlinks.com/bank statement. This is a good moment for one line we live by. Strategy beats rate, always. Before we look at next week, I want to put a tool in your hands called Debt Done Date. Here's how it works. You enter all your debts, and we'll show you several ways to pay off everything. We're talking your mortgage, auto loans, student loans, credit cards, and other debts. It gives you a clear finish line and a real plan to get there. Get started at rsrlinks.com/DDD. That's rsrlinks.com/DDD. Let's look at next week. It's a lighter week for economic news, and the Fed goes quiet ahead of its July 29 meeting. On Thursday, we get the weekly jobless claims. On Friday, watch for new home sales and building permits. With less on the calendar, news out of the Middle East and big swings in the market could be the main movers for rates. We'll break it all down for you next week. That's your weekend update. You can watch the full update at rsrlinks.com/WUC. We appreciate you listening, and we'll speak to you again next week.